Debt policy and optimal capital structure. Now, a company can use various sources of financing uh, to finance operation. They can use debt, they can use equity, or any other form of financing. To keep things simple, let's consider that the firm can use debt and equity. Okay, so the firm can use 100% debt to finance the operation, 100% equity, or 50% debt, 50% equity, or maybe 60% debt, 40% equity, or vice versa. The question is there an optimal mix of financing for the firm? To answer this question, we're going to proceed by answer several short questions that lead us to the answer. First, let's put ourselves in a perfect world. What we call a perfect world is uh, a world where there's no transaction cost, where information is freely available to all market participants, where there's no taxes. This is what they call the Modigliani Emilia world or world. And in such world, let's consider two firms, firm L and firm U. Firm L and firm U are identical in all respects, except that firm L use both debt and equity to finance the operation, while firm U use 100% equity to finance this operation, therefore zero debt. In such world, the total market value of the firm debt and equity equals the value of the firm as if it was all equity finance. So we have VL equal VU. Basically, the results say that in a perfect world, debt policy is irrelevant. That means it doesn't matter if you use debt or not, it doesn't affect the value of the firm. That's it. Now, let's look at what's happened in a perfect world with taxes. So here we're going to have a perfect world, but that was not 100% perfect. We're going to add one tiny imperfection, which is taxes. In a perfect world with taxes, VL equals VU plus TB. So VL is the total market value of the firm debt and equity equal the market value of the firm as if it was all equity finance plus the tax shield benefits, which is obtained by multiplying the total market value of the bond outstanding by the corporate tax rate. And TB is the present value of all tax savings on interest deduction that the firm made. When you borrow money to finance an operation, all the interest expenses you pay is tax deductible. So that's one of the motivation to use borrowing to finance the operation. Okay, so we have VL equal VU plus TB. So basically, what we get here is that it pays to borrow to finance firm operation. That basically is raise the value of the firm as a tax shield benefit. The question is, can we continuously borrow and continuously raise the value of the firm as a tax shield benefit? Well, it's maybe this is true in the perfect world with taxes, but really in the real world. In the real world, what's happened really? In the real world, as a firm continue to borrow, well, they increase the likelihood that at a certain point, the revenues they generate won't be enough to service the debt, that to pay interest and principal when they due. And therefore, if the firm continue to borrow, they're going to get a certain point, they won't be able to pay some of the bill. So they're going to experience what they call financial distress. And if they're very stubborn, they continue to borrow, well, they're gonna file for bankruptcy. And bankruptcy is very costly to the firm because managers have to go to court to manage bankruptcy proceeding rather than running the firm. So bankruptcy costs money. And this, because this cost will reduce the value of the firm. So in the real world, that's the world where you and I live, the value of the firm, the total market value of the firm, debt and equity, equal the value of the firm as if it was all equity finance, plus the tax shield benefits, minus the present value of expected bankruptcy costs. Next question we're going to consider is that how does capital structure affect the cost of the equity capital? Okay. So here you're gonna draw on the y-axis the cost of equity. On the x-axis, we're going to draw what's it called financial leverage, as measured by debt over equity. Also, that ratio also equal the total market value of the bond outstanding divided the total market value of the stock. Okay. Now, so we're going to look at the idea is that how does capital structure affect the cost of the equity capital? For the unleveraged firm, U, the firm U, cost of equity. This firm does not use debt, so debt does not affect its cost of equity, none whatsoever. And therefore, as leverage increase, the cost of equity capital for the unleveraged firm remain constant. And what is value? That cost of equity capital is a discount rate. It's a discount rate, it's a cost to the firm, that is a return to investor. As any return is going to be the risk-free return plus a risk premium. But this firm does not use debt. So in that risk premium, there's no financial risk premium. It's only business risk premium. So KU, the cost of capital for the unleveraged firm, is going to be the risk-free return plus the business risk premium of the firm. So that's where it starts. It's flat. What about the firm that use both debt and equity? As leverage increase, the financial risk increase. And therefore, provider of equity capital, they're going to ask to be paid to take that extra increase in financial risk. And therefore, the cost of capital for the leverage firm is going to be upward sloping a straight line like that. Now, this is it remains a straight line in a perfect world with taxes. What about in the real world? In the real world, in addition to as leverage increases, you have what financial risk increase, but also there's a risk of bankruptcy. Therefore, investors are going to ask for even a higher payment to bear that increase in financial risk and that increase in possibility of bankruptcy risk. So the cost of capital for leverage firms is going to be is follow the straight line upward sloping, and then it increases dramatically exponentially like that. Okay. Now, what about the cost of debt? So when the firm borrow, as I told you, I said initially that all interest payments are deducted from taxes. So this is one of the motivations that a company borrow to finance the operation. So the true cost to the firm, the true cost of borrowing is the after-tax cost of borrowing. So if I call K prime D the nominal cost of borrowing, and T is the corporate tax rate, the true cost of borrowings are called KD is going to be K prime D multiplied by 1 minus T, corporate tax rate. So K prime D is going to be like that. It's flat and then increase gradually, and as the firm get closer to the debt capacity, increase dramatically. And KD is going to be lower because after tax, so it's going to be lower. It follows the same pattern, increase dramatically. Now, the next question we're going to ask, how does capital structure affect the overall cost of capital? The overall cost of capital, also called the composite cost of capital, or also the weighted average cost of capital. For instance, let's say you have a company, you need 1 million to finance a project, and out of 1 million, you're gonna raise 500,000 using debt and 600,000 using equity. So the proportion of debt in your finance is going to be 40% and equity is 60%. So the composite cost of capital is going to be the weight in debt multiplied by the cost of debt multiplied by 1 minus corporate tax rate plus the weight in equity multiplied by the cost of equity. Okay. So how does capital structure affect that weighted average cost of capital? First, we're going to put ourselves in a perfect world. In the perfect world, so here we're going to have it's going to be cost on the y-axis. On the x-axis is going to be financial leverage as measured by debt over equity, but also equal total market value of the bond outstanding divided total market value of the stock. Okay. Now we're going to look at first the cost of debt. The cost of debt is going to be flat. Okay. So this is the perfect world with no taxes. Remember, in the perfect world with no taxes, that VL equal VU. That means the total market value of the firm stock and bond equals the value of the firm as if it was 100% equity finance. So debt policy is relevant. So the cost of debt is going to be flat as leverage increase. Okay. So because debt policy is relevant, it's going to be flat. And then what about the cost of equity? As leverage increase, there's increase in financial risk. So provider of equity capital asks for payment to assume that increased financial risk. So the cost of equity capital is going to be upward sloping. Now, what about the weighted average cost of capital? Remember that in a perfect world with no taxes, VL equal VU. That means the value of the firm is constant, is independent of leverage. Okay. And then how do you get the value of the firm? We can value the firm as a perpetuity. It's going to be the constant earning before interest and tax multiplied by 1 amount divided by discount rate. And the discount rate is the weighted average cost of capital. For the value of the firm to remain constant, the discount rate must be constant. And therefore, the weighted average cost of capital is constant as leverage increases. It's going to be flat. Now, let's look at the case of a perfect world with taxes. In a perfect world, you can. So here we're going to have costs on the y-axis and then leverage as measured by value of bond over value of stock on the x-axis. So cost of this is going to be flat. Now, cost of equity and leverage increase, financial risk increase, so provided equity that has to be paid to assume that extra risk is going to upward sloping. Now, what about the average cost of capital? The average cost of capital, what's happened is that in the perfect world with taxes, that the value of the firm, VL equal VU plus TB. So the value of the firm increased by the tax benefits. And the value of the firm is obtained, is valued as a perpetuity as earning before interest and tax 1 minus tax divided by the discount rate, which is the weighted average cost of capital. For the value of the firm to increase, as leverage increases, the discount rate must decrease. So the discount rate, weighted average cost of capital, is going to be a downward sloping straight line. Okay. So this is in the perfect world with taxes. Now, in the real world, what's happened? So again, we're going to, on the y-axis, we're going to have cost. On the x-axis, we're going to have leverage as measured by debt over equity. So first, cost of debt is going to be flat and then increase gradually, and then we pass the debt capacity increase dramatically like that. Now, cost of equity is going to be upward sloping and then increase exponentially. And then the weighted average cost of capital. Remember, in the perfect world, VL equal VU plus tax sheet benefits minus present value of expected bankruptcy costs. Okay. And therefore, basically what's happened initially as this firm starts borrowing, the value of the firm increase. Okay. And then when they reach debt capacity to continue borrowing, as the firm experiences financial distress and bankruptcy, the value of the firm decrease. Now, since the firm is valued as a perpetuity, as earning before interest tax 1 amount tax divided by the discount rate with the weighted average cost of capital, when the value of the firm increase, the weighted average cost of capital, the discount rate decrease, and when the value of the firm decrease, it increase. So the discount rate, as measured by the weighted average cost of capital, in the real life is going to be decreasing and then increasing. So it's reached a certain minimum. Around that minimum is what they call the optimal capital structure range. Okay, so that minimum corresponds to the minimum value of the weighted average cost of capital. That means at the point where the cost of financing the firm is the lowest possible. And this also point corresponds to the maximum value for the firm. So yes, the answer, is there an optimal mix of financing? The answer is yes. There's an optimal mix of financing that lowers the firm overall cost of capital and maximizes the firm's value. Thank you.